U.S. Market Brief, January 20th, 2026. Here is your U.S. Market Brief for Tuesday, January 20th, 2026. U.S. equities closed sharply lower as risk sentiment deteriorated amid renewed concerns over U.S.-Europe trade tensions and a global rise in bond yields triggered by volatility in the Japanese government bond market. Markets reacted after President Trump escalated rhetoric around potential new tariffs, signaling possible trade measures against countries opposing the Greenland acquisition. As a result, equities, treasuries, and the U.S. dollar weakened simultaneously, reflecting a broad risk-off move. The S&P 500 declined more than 2%. Erasing most of its year-to-date gains, while the VIX Volatility Index rose to its highest level since November, highlighting elevated market stress. In rates markets, Japan was the focal point. The 10-year Japanese government bond yield jumped roughly 19 basis points over 2 days, while the 30-year yield posted its largest single-day increase since 2003. The move followed Prime Minister Sanae Takaichi's announcement of an early election and expansive fiscal stimulus plans, which raised concerns about increased government borrowing. Adding to global rate pressure, reports that Denmark's Akademiker pension is considering reducing exposure to U.S. assets contributed to a sell-off in U.S. treasuries, pushing yields to a 4-month high. Trade and geopolitical risks also intensified. President Trump warned of stepwise tariffs ranging from 10% to as high as 25% on certain NATO member exports, and separately threatened up to 200% tariffs on French wine and champagne amid escalating tensions with European leaders. That said, several institutional investors view these tariff threats as negotiating tactics rather than an imminent policy shift, suggesting that headline risk may be outpacing concrete policy action. Looking ahead to Wednesday, January 21st, markets will be watching U.S. MBA mortgage applications, the Conference Board's leading economic index, existing home sales, and notably, the 20-year U.S. Treasury auction, which could further influence rates and broader risk sentiment. Now let's go one level deeper. On Wall Street, sessions like this are framed less as a single headline and more as a shift in how risk is priced. I'll break it down through 3 institutional lenses: equities, commodities, and policy. First, the JPM-style framework, tactically constructive but hedged. The idea is simple. The tape can look ugly, but if fundamentals hold, the market can absorb a lot of noise. So the response is not all risk off, it's stay invested, but buy protection. The 2 immediate stress points are clear. One is tariff uncertainty tied to the Greenland narrative. The second is rates volatility, especially when Japan's bond market drives global repricing. The counterweight is earnings power. If earnings expectations remain intact, drawdowns tend to become rebalancing opportunities rather than exit signals. The playbook is exposure plus seatbelts. Maintain core allocations, but add downside hedges like VIX calls or index puts when positioning is crowded. Second, when policy risk rises, part of the risk premium often migrates from equities into real assets. Precious metals respond not just to inflation, but to policy credibility. This is often described as the debasement trade. Oil remains a 2-speed market. Structurally, supply can look ample, but short-term disruptions and sanctions often create a floor under prices. The takeaway is not that commodities always rally, but that they can absorb uncertainty when policy risk dominates. Third, policy reaction functions matter as much as economic data. Markets price how governments respond to stress. In China, slowing exports increase the probability of a policy put. Markets may price stimulus even as data weakens. In the US, measures resembling price controls can reduce pain in the short run, but tend to increase friction over time by delaying adjustment. Together, this means equities balance fundamentals, commodities absorb part of the risk premium, and policy expectations increasingly drive cross-asset moves. That's the institutional read, frameworks over headlines. From here, the key question is whether rates stabilize and whether tariff rhetoric converts into policy. We'll continue to follow the data, not the noise. So here's the question. In an environment like this, where geopolitical risk and global markets can shift by the hour, and yet the Nasdaq and the S&P 500 have continued to trend higher over the long run, how do we invest with a posture that resembles how institutions position in markets? Warren Buffett has said it plainly: buy the index. Over time, the power of compounding will do the heavy lifting. That idea is now almost a universal investing principle. So let me ask you this. If indexing is so powerful, why do so many individual investors still fail, even with index exposure? The answer is psychological. Individual investors struggle with 2 forces at the same time: fear when prices fall and impatience when results do not arrive quickly. You buy an index, and if it declines shortly after, anxiety sets in. Or you invest, but the market doesn't rally fast enough, and you start questioning the plan. And when investors begin to anticipate a 10 to 20% drawdown, many abandon their long-term process precisely when discipline matters most. If we view this with emotional distance, it is not about blaming anyone. It is a structural outcome of how markets operate. Over the last 20 years, the Nasdaq and the S&P 500 delivered substantial long-term gains, but that growth was never linear. It included repeated drawdowns, volatility spikes, and long recoveries. For example, during the oil shock era in the 1970s, the S&P 500 fell roughly 40% from peak to trough, and it took approximately 2 years to recover prior highs. In periods like that, many individual investors could not stay invested. The size of the decline and the time it took to recover created uncertainty that overwhelmed discipline. In institutional language, we call this two different forms of correction: price correction and time correction. Markets do not only test your capital, they test your patience. If you want to invest like the great long-term allocators, you must be able to endure both. But here's the problem: humans are not robots. Under fear and greed, sticking to a process is harder than most people expect. That is why many investors end up doing the opposite of what they intended, selling near lows, then re-entering near highs, repeating the cycle over and over again. This is not simply a knowledge problem, it is a behavioral design problem. Human nature is wired this way, and markets operate with that human behavior as a baseline. So the real question becomes, how can an individual investor correct for this structural disadvantage? Now let's walk through a practical solution. Now let's walk through a practical way to reduce two structural weaknesses most individuals face: emotional decision-making and lack of a rules-based process. Today, I'll demonstrate the Pikol Futures Grid Bot as an example of a rules-based framework, one that distributes buy and sell orders within a predefined price range. Important disclosure: this is for educational purposes only and is not investment advice. Futures trading involves significant risk. Leverage can increase liquidation risk, and fees and slippage may materially impact results. This is the Pikol homepage. From the top menu, go to Futures, then select Futures Bot. Once the chart loads, you'll see the market and instrument selector on the left. For this demonstration, select the RWA category. This section includes a range of major, highly traded tickers. To keep the example simple, I'll use silver, SLVX USDT. After selecting the instrument, on the right panel, choose Futures Grid. Then click Create. Next is Customize. The goal here is not to guarantee profits, but to define how risk is contained and where the system is allowed to operate. Start by setting the price range. For example, if the current price is around 86, I'll set a lower bound at 40 and an upper bound at 110. Now set the number of grids. For this example, I'll use 500 grids. One key point: more grids can mean tighter execution, but it can also increase the impact of fees and slippage. So grid density is not automatically better. It must match the market environment and risk constraints. After applying the settings, the grid structure becomes visible. The green levels represent where buy orders are distributed as price moves lower, and the red levels represent where sell orders are distributed as price moves higher. Zooming in, you can see how densely buy and sell levels are placed even on shorter time frames. The core concept is not prediction. It is systematic execution within a defined range. When orders are filled, the system can replace orders to maintain the strategy logic within the grid framework. Here you can review transactions and see how fills occur across the grid. And this is the critical risk point. Even if grid-level profits appear positive, total P&L can look very different. Unrealized P&L, leverage, liquidation price, and margin structure must be evaluated together. Otherwise, risk is easily underestimated. So the value proposition here is not automatic profit. It is reducing emotional interference and maintaining a rules-based process, with risk controls clearly defined. Next, I'll outline a risk checklist for using automated strategies responsibly. Let's assume we run a Nasdaq tracking instrument like QAQ using a futures grid bot. The core idea is structural: maintain long-term index exposure while using a rules-based automation layer to manage volatility along the way. This is not about prediction, it's about process. Important disclosure: this is for educational purposes only and is not investment advice. Futures and leverage involve significant risk, including liquidation. Automated strategies can generate losses. Withdrawal availability and conditions depend on platform policies, liquidity, and network status. 1. Keeping capital working through volatility. A grid framework typically operates within a predefined price range, placing systematic buy and sell orders to monetize fluctuations. The value is not guaranteed profit, but reduced emotional interference and consistent execution. 2. Realized gains retained as margin and liquidation dynamics. If Picol's configuration credits realized gains into margin, realized profits can act as buffer capital, which may lower the estimated liquidation price and improve resilience. However, liquidation risk does not automatically disappear. It remains a function of leverage, volatility, margin mechanics, and price behavior. The correct framing is risk buffering, not a guarantee. 3. Compounding example. To illustrate compounding, assume $10,000 principal, 60% annual return, fully reinvested. After 1 year, $10,000 x 1.6, $16,000. After 2 years, $16,000 x 1.6 more $25,600. After 3 years, $25,600 x 1.6, $40,760. After 4 years, $40,760, 1.6, 165,536 in returns are not constant in real markets and drawdowns occur. The point is that reinvestment can change the growth rate over time if gains persist. 4. Using 50% as a stress test, not a promise. Many range-based approaches reference historical drawdowns to design stress ranges. In the last about 20 years, large drawdowns have occurred, and recovery has also occurred over time. A strong institutional way to position this is, we design with a 50% stress band as a conservative buffer, but the professional footnote is essential. Over longer history, deeper drawdowns have occurred, so leverage and stop conditions must remain conservative. 5. Why this framework can be powerful. The edge is behavioral. Most retail failure is driven by emotion during volatility. A rules-based automation layer can reduce emotional mistakes and enforce consistent execution. Next, we'll cover a risk checklist, leverage limits, range design, stop conditions, and the impact of fees and slippage. This channel is not about chasing headlines, it's about reading how risk is priced and responding with structure. We publish practical resources, setup guides, and reference links as your QR access inside our Telegram so you can implement a rules-based risk framework. You'll find the Telegram link in the channel About section and the pinned comment. We cover major assets, from index exposure such as QQQ to large cap equities, gold and silver, and digital assets like Bitcoin and Ethereum through one consistent lens, risk control first. In daily briefings, we break down where volatility is coming from, how rates, policy, and earnings are being repriced, and what fundamentals imply for risk going forward. The most expensive asset in markets isn't information. It's a framework that holds under pressure. That's what we deliver, daily. Important disclosure. This content is for educational purposes only and does not constitute investment advice. Automated strategies and futures leverage involve significant risk, including liquidation. This is Money Hacker, frameworks over headlines. Subscribe, review the resources, and we'll continue from the next brief.